Good afternoon, ladies and gentlemen. Welcome back to the 17th of February weekly market review. I hope everyone had a very good Valentine's Day. Today, as usual, I have with me Gerald. Gerald, how are you over the weekend?
Was a very busy weekend. Together with SIAS, we were at the Singapore Financial Conference, sharing with very passionate young individuals from our universities around how to get started with their financial planning, how to start investing. So it was a very busy Saturday afternoon for all of us at SIAS.
Yes, I also saw a lot of reports in the media on that as well. Great to see that a lot of young investors are sort of taking charge of their financial literacy and their financial planning to have a very secure financial future ahead of them. And back to the market last week, we saw some of the major US macro data, including the CPI, PPI, and the retail sales, which in my opinion is kind of a mixed bag. And that may not be a bad news. That could actually be a good news because it shows that inflation as a whole may not be running away or accelerating very fast, and then we would have less pressure on the interest rate hike, or more or less to say that we may still have chances to see a rate cut this year. So the latest on the CME Fed Watch 2 is likely we are going to see one rate cut instead of two. So as what I spoke with Gerald earlier, that could mean more gains for the Singapore banks and a slightly more pain for the REIT sector, which their rebound could get delayed a little bit more. Okay, so before we go further, I will let Gerald take over the show to go through some of the details that happened last week.
Okay. As usual, today's sharing is for information purposes only and should not be taken to be financial advice. If you find our weekly market review helpful, do leave us a review on Google. And if you're wondering how you can join SIAS as a member to be able to access various online resources, investor education programs, you can scan this QR code or go to the website sias.org.sg/membership. Okay, so with a quick recap of how the global markets performed last week, we saw the S&P 500 actually going back to above the 6,100 level, now back to close to its all-time highs once again, and likewise Nasdaq back to above the 20,000 point mark. So this is really driven by what I will share later, because of some expectation that Trump will delay the tariff, and that helped to lift sentiment towards the markets. Closer to home, we saw STI at one point getting to an all-time high of above 3,900 points, but still closing the week at 0.4% up compared to the previous week. Okay, so what did we see in the past week? US President Donald Trump decided to delay the implementation of the new tariffs. What he introduced instead is this thing called a fair and reciprocal trade plan, where he mentioned that there will be country-specific reciprocal tariffs by 1st of April after further evaluation. So investors reacted positively to this announcement because it was seen as a postponement of further tariffs, some of which were supposed to come through this week, next week, or in the near term. And more importantly, this opened up a window for the US trade partners to be able to begin their negotiations. Okay, the other key data point that came out last week was the US inflation data. Here we see the US Consumer Price Index data. In January, it was up by 3% compared to the previous year. This was above market expectations. And what we see is the market disregarded this piece of information, mainly because this was exceeded by the improved sentiment coming through from the Trump delay of tariffs. Okay, if you're to look at the Singapore market performance, the divergence between the top performer and the worst performer was fairly large. First and foremost, we saw Seatrium up by 19% after it announced a memorandum of understanding for a further floating production unit which is meant to go towards the US. So seeing improving order momentum for Seatrium, and that's helped to lift sentiment towards the stock. Outside of Seatrium, we have Yangtze Shipbuilding, Genting Singapore, Singtel, and Venture, also as top gainers in the past week. If you were to look at the worst performers, we have a number of REITs, CapitaLand, Ascendas REIT, Mapletree Industrial Trust. We also have SGX down by 9.3% after a broker downgrade to sell on expectations that maybe the expectations are overly high for SGX. Okay, there are two names that I wanted to go through today. The first is DBS that reported its earnings last Monday. We see the share price actually hovering at very strong levels, closing still close to the $45 mark as of Friday. Okay, so what did we see for DBS's earnings? If we were to look at the net profit, it was up by 10% to 2.62 billion. If you were to look across various line items, total income grew, the profit before allowances grew. So we see the strength in the earnings across the board. First, we look at the net interest margin for DBS. If you were to look at the group net interest margin, it was at 2.15%, just above where it was in the third quarter of this year at 2.11% and higher than where it was in the first and second quarter of this year. So while we are seeing some concerns around whether the fall in interest rates will actually affect its net interest margin, overall, we see that the net interest margin has been fairly resilient. And with this, we've seen an increase in its net interest income to 3.7 billion in the fourth quarter of this year, as it continues to be able to attract loan growth and be able to earn a resilient net interest margin. Okay, next we look at the fee income, and what we see here is that the strength in the wealth management income continues to be there. 520 million of wealth management fee income in the fourth quarter. That is up significantly from the fourth quarter of last year, 41% growth. And we see that that has actually helped to grow the overall fee income for DBS to 1.2 billion Sing dollars. Okay, outside of that, we also saw that it was able to earn higher other non-interest income. So overall, that helped to lift the profit for DBS. The other good news for DBS is that the dividend was increased. We saw an increase in dividend to 60 cents per share in the fourth quarter. So that will bring the total dividends in 2024 to $2.22. Okay. At the same time, the company has also announced a capital return dividend for 2025. So what this means is that if you are looking at 15 cents per quarter for 2025, then overall, we are looking at potentially additional 60 cents over the full year of 2025. And if we add on to the 60 cents that we saw in the fourth quarter and analyze that, we might potentially be looking at a total of $3 of dividend for DBS in 2025. Okay, so at this point in time, if you look at the valuation of DBS, PE of 11 times, that is above the historical average. While the share price is very high compared to the historical average, what we see is that because the earnings has also grown, so that is why on a PE basis, it is at 11 times PE. On the other hand, on a price to book basis, it is now at 1.9 times price to book, which is significantly above the historical average and also partly justified by the higher return on equity that DBS has been able to make over the past few years. Okay, if I were to look at the dividend yield, the historical dividend yield of 5.4%, That is above where it was in the past, which was at 5%. And looking forward to 2025, based on what I shared earlier, if it is able to pay out the $3 per share, then that will represent a dividend yield of close to 6.7%. Okay, next I'll talk about Paragon REIT. The other big news in the Singapore market last week was that Cascaden Peak, the sponsor of Paragon REIT, is offering to privatize the REIT at 98 cents per share. In addition, the REIT will pay a second half FY 2024 cash distribution of 2.33 cents. Okay, so we see the stock reacting to this news, bouncing to about 99 cents upon the announcement of this offer. Okay, if we were to look at the offer price of 98 cents, that will represent a price to NAV of 1.07 times. That is above the S-REIT retail peer average. It is above the privatization average of previous transactions, as well as Paragon REIT's historical average, whether we look at it from a 1-year, 3-year, or 5-year perspective. Okay, so some of the reasons that was given for this privatization include that overall we have seen low trading liquidity for Paragon REIT. So this can potentially offer investors a chance to be able to unlock the value through the offer. Okay, what the REIT manager has also shared, which I'll go into a bit more detail later, is that they plan to undertake a major asset enhancement initiative at Paragon, which is the key asset for Paragon REIT. So this can potentially bring execution risk as well as distribution fluctuations. Okay, so with this potential risk, they see that that might be something that they are able to better take on rather than unit holders, and that was one of the rationale that was given for this privatization. Okay, so earlier I shared about one of the rationale, which is the limited liquidity for Paragon REIT, and that is what we see for the share price trading volume versus the total percentage of units outstanding compared to some other names such as CICT, Liberty Pan Asia Commercial Trust, Land Lease REIT, FCT. The liquidity is actually fairly low. Okay, so that has effectively limited the REIT's ability to access capital markets for portfolio expansion. Okay, at the same time, they have announced that there is a potential asset enhancement initiative at Paragon, which will cost 300 to 600 million and taking 3 to 4 years to complete. So Paragon at this point in time represents 72% of the portfolio, and given that it is a very big asset for them, that can bring potential execution risk. Okay, so this is what we see in terms of the illustration provided by the REIT manager, based on 300 million of capex, assuming that there is a 10% reduction in the net property income, the DPU can potentially have a 21% hit. And if we're looking at a more significant disruption to the NPI, then the distribution can even be hit by 50%. On the other hand, if the capex goes up to 600 million, then the impact to the NPI is going to be even more significant, and we are potentially looking at an impact to the distribution per unit of up to 64%. Okay, so based on the different scenarios that we have discussed and what the REIT manager has shared, the current distribution yield of Paragon REIT is 5.1%. If you are looking at such a hit to their distribution, then the DPU yield can potentially end up at about 1.8% to 4% instead. Okay, so those were the rationale that REIT manager has actually mentioned. So at this point in time, what's going to happen is that there will be a scheme of arrangement, And what this means is that the required unit holder approvals will be that more than 75% of voting rights held by unit holders present and voting at the EGM. And for the approval of the scheme, more than 50% of the number of unit holders, representing more than 75% in the value of the units present and voting at the scheme meeting. Okay, what's important to note is that Cascadian Peak and its subsidiaries, which hold 61.5% of Paragon REIT, will actually abstain from voting in this scheme. Okay, so in terms of the timeline, we saw the announcement last week. We will have the dispatch of the scheme documents sometime in March, potentially the scheme meeting and EGM held in April. And if it goes through, then we have the effective date and payment of the scheme consideration in May this year. Okay, so those are the key big events last week, including DBS earnings and the offer for Paragon REIT. For this week, we continue with the earnings season, with UOB earnings being in the spotlight. We also have the Singapore budget that will be announced tomorrow, 18th of Feb. And on the global macro front, we have the US FOMC meeting minutes out on Thursday, 20th of Feb. Okay, so with that, I'll hand over to Sunny, who will share with us the technical analysis.
Okay, thanks a lot, Gerald, for sharing with us some of the detailed happenings that happened in the Singapore market last week. So I just want to, before I start doing a recap on the charts, I just want to show you the probability of the interest rate cuts that we are expecting from the CME Fed Watch tool. Right now, the latest updates is like we will likely see only one rate cut of 25 basis points this year until end of 2025, and that could likely happen in the second half of this year in the July period. Okay, so bringing this news back to the DBS report that was announced last Monday, they were expecting 2 rate cuts for the second half of 2025. That means that with now the latest development as of last Friday, to see 1 interest rate cuts, that could mean further upside for the Singapore banks and DBS, which could contribute to their highest net interest margin. Okay, so the STI actually touched a new all-time high at 3,921 points last Monday, carried up by the DBS results. And also we saw what Gerald shared earlier, Citrum also had a very significant big bounce of 19-20%. Okay, and with still 2 banks yet to announce their result. One is coming up this week and one on the 26th Feb, which is OCBC. UOB is this week. The STI likely would have a further upside to come, and I think testing at least the 3,921 points that we saw last Monday is likely not a problem. Okay, so early morning 17th Feb today, we saw that the STI is up about 0.38, 0.4%, up about 14 points. So this is building on last week 0.4% gain. So we are actually on a very good footing. And last week also we hear that our economy also grew by 4% year on year. So that is another good sign that Singapore economy is doing well. So there's a lot of a positive sentiment right now in the market. Okay, so on the STI index, definitely near term we are targeting to break the new all-time high at 3,921 points. And then on the longer term, towards the end of the year, I believe we are likely going to target the 4,000 handle for this year, given that like what I shared earlier, that we are only expecting to see 1 rate cut this year. And if that scenario plays out, then the 3 local banks being the major components of the STI index will likely carry the STI index higher. And if let's say we reach that point, we are about 100 points away from that 4,000 handle. So that is the target that we are looking at. Support-wise, of course, if let's say there's any bad news, there's any things that Trump announced that could be impacting Singapore or the global economy, then definitely a pullback towards the 20 days moving average, which has always been a very good support for the STI, that would be now at around the 3,833 points level. Anything below 3,008 would definitely be an accumulation level with the 50 days exponential moving average, the blue line that you see here, at 3,801 points. Okay, MACD indicator, we have a positive reading, although the trajectory of the MACD and the signal line isn't that much higher, but that could also signal that it is on a sustainable uptrend that we are looking at. Market is not really sort of in a overbought kind of a scenario yet. We can see that the candlesticks are also still within the Bollinger Band. So that is a good sign that the uptrend could continue. That will don't have that much of a big momentum as of now. On the RSI, we also have a healthy reading of 64. So before it hits the 17-point mark, which will indicate that it is overbought. So for now, I think we will still trend and we'll try to target a 3921 all-time high this week. Banging on the UOB results that will be coming out. And then, of course, if that push us high enough, then we have the next week OCBC results on the 26th of February to push the STI index higher. Okay, so that's my take on the STI index. Overall, still positive, and we are looking on the longer term towards the 4,000 handle. Next, let me move to the US side of things. So as what Gerald shared earlier, I think the indices gained, I think the Nasdaq Composite Index gained over 2% last week. S&P 500 was up 1.5%. So overall, it's still a very positive US market. Of course, the big news was Donald Trump. We got more clarity on what Donald Trump tariff plans is, and it was pushed back towards April. So that gives us a bit of a more breathing room. Okay. On the Dow Jones Index, which is the top 30 market cap stocks in the US, we can see that it was down about 0.37% last Friday. But on the week as a whole, it is also down slightly at 0.48%. But we can see that it is now resting comfortably on the 20 days moving average. So that is giving it some support as of now. But according to the indicators, MACD has turned negative already. So probably we will see a bit of a technical pullback towards the lower bound of the Bollinger Band or the exponential 50 days moving average in the blue line, which has found some kind of conversion around the 43,850 points level. So 43,850, that will be the accumulation point on the Dow Jones Index. The RSI is also slightly coming down. It is still at a positive above 50-point neutral point of reading at 55 points as of last Friday. So that is still a good sign that there is still at least some uptrend momentum inside the Dow Jones Index right now. So it should not come off too much, and hence I was saying that the lower bound of the Bollinger Band could likely provide that support for the Dow Jones to come back up again if, let's say, we had a pullback towards the 43,850 points level. So that's the level that I'm looking at to accumulate further on the Dow Jones Index. Next, let's move to the broader index. The broader index, we were more or less muted on Friday, but on the week, we are up about 0.5%. So we are also very close to the all-time high of 6,128 points, just about 10-15 points away. So I think to have a higher high above that, a new all-time high, is very likely possible on the S&P 500 index, and that could come on the 26th of February, which is also the NVIDIA's announcing their results. Okay. So looking at the indicator-wise, we still have a positive MACD reading. So that means that the uptrend is likely going to continue. There's still uptrend momentum in the S&P 500 index right now. And looking at the futures, early futures trading this morning in Asia time, we also saw that all three major US index futures are also positive. So that means we could likely see a positive open on the US index tonight. Okay, so that will be good news for the S&P 500 index. RSI is positive at 58 points. So that also means that there's still some quite a significant amount of uptrend momentum presence in the S&P 500 index. So likely we will break the 6,128 points level. Anything above that, we don't have a guidance as of now. But likely we may be able to see it test the 6,200 level in the near term if we have a positive results from NVIDIA towards the end of the month. Okay, and the outperformer last week among the three US indices, of course, will be the tech-heavy Nasdaq Composite Index, now above the 20,000 point. The previous all-time high that we saw was somewhere in December. That is at 20,200 points. So we are about 180 points away from that level. So that could also be the near-term resistance that we are looking at. But looking at the chart movement, the MACD indicator is positive. So that means the uptrend will continue, positive momentum still present. The RSI at 58 also shows some significant amount of uptrend momentum present in the uptrend that we have been seeing in the past 1 month. So likely we are going to trend up further. Of course, 26 Feb NVIDIA results would likely sort of get the Nasdaq Composite Index to retest the all-time high at 20,204 points. So a lot of things to look at in the coming 2 weeks, and with the FOMC meeting this week, it will also give us some kind of signal of how the Fed is looking at the inflation rate and the rate cuts going forward. Okay, so we'll update you along the way as things develop. Anything else to add, Gerald?
Yeah, so I think we'll definitely be looking for the FOMC meeting updates. We also have the earnings season that is coming into full play this week, with UOB earnings to look out for. And personally, for myself, I'll be looking at the budget as well to see what actually comes out from it.
Yes, so there could be more catalysts coming out this week. So do stay tuned to what the market is going to sort of develop and announce. And we will update you again right here on this weekly market review show next Monday as well. So everyone have a good trading week ahead, and we'll see you next Monday, same time, same place on the next weekly market review. Bye.
Thank you.